Hello and welcome everyone. It is a great pleasure that you're joining us for today's investment talk, Asia Pacific, what's next for global investors. While we just kicked off the working week in Germany, our Asian colleagues are, as per the law of time, a day ahead and will soon be able to wrap up this Monday. In this global crisis that we're all bearing witness to at the moment, we're all looking to see how they tackle the events. And as the first ones to be severely affected by the pandemic, they are already showing us and leading the way how to move on and deal with the implications for our business life. Particularly for global investors with a global reach, the real estate markets in the Asia Pacific region are an important and strategic component of their portfolios. Their focus lies on large volume markets such as Japan, South Korea, and Australia. In addition, it is precisely the diversity of different investment markets that makes this region so attractive. So please join me in welcoming Terence Tang, Managing Director at Singapore, and Matthias Leube, CEO Colliers International Germany, who will discuss the current market dynamics together with their guests, whom I'm also warmly welcoming to the table. Thank you for being here. Well, we will look into your presentations and discussions in a minute. Beforehand, I would like to make the audience just notice that this digital talk does not merely intend to be an opportunity to eavesdrop. You're all invited to share your questions and remarks with us, and please use the chat function to do so. We will then hand over your questions to the panel later on in the Q&A session. Now, without further ado, let me hand over the baton to Matthias Leube, and we're looking forward to your debate. Please.
Thank you, Janne. Ladies and gentlemen, welcome to our Asia Pacific webinar. Colliers is undertaking over 40 webinars covering the global regions, asset classes, wanting to provide an overview of the key trends ahead. And I'm happy to welcome Laurent Jacquemin from AXA Investment Managers, who is heading the Asian operation, and Jason Lee from AEW. Laurent is joining us today from Tokyo, Jason from Taiwan, and I'm happy also to introduce Terence, who will give us a short overview of the Asia Pacific market and trends ahead, and he's joining us from Singapore. Terence?
Hi, thank you, Matthias. Now, shall we let our guests introduce themselves about where they are from? Yeah, maybe we start with Laurent.
Yes, thank you, Terence. So Laurent Jacquemin, I'm head of Asia Pacific for AXA Real Assets. So we are roughly managing 6.5 billion euros of assets in the region, exclusively in Japan and Australia, which are the two markets that we are covering. We're also raising capital from all the region. And 6.5 billion is still a small amount within the 103 billion euros that we are managing globally, but our ambition is to grow in this part of the world, which is very attractive, and I'm sure we'll discuss that further later on.
Thank you, Laurent. Maybe Jason?
Great, thank you. Hi, everyone. Jason Lee, AEW. I'm responsible for our acquisitions here in Asia. AEW is an 80 billion AUM global management company. In Asia, we're already in Japan, in Korea, in China, Hong Kong, Singapore, Australia. And over here, we have been here for more than 13 years, continue to expand.
Okay, thanks. Thanks to Jason and Laurent and Matthias. Hi everyone, I'm Terence Tang. I run the capital markets and investment services business in Asia, based in Singapore. We have teams across all key markets in our 30+ offices in Asia Pacific, and our almost 200 strong investment experts work closely with our colleagues in EMEA and the Americas across the group. As you guys see, this is the first slide. What I will do is I will just share you a couple of slides. There are 4 actually in total. I will go through these 4 slides to set the scene for what is happening to the investment market in Asia Pacific today, and then follow that my colleagues Matthias will moderate the panel I'm so glad that both Jason and Laurent can join us today. Okay, in this first slide, maybe I'll start off with the slide. In this first slide, you can see the changes in the investment transaction volume across all the regions, Americas, Asia Pacific, and the EMEA. And as you can see, the volume has really dropped substantially across all regions. This is a year-on-year data. So as at end of second quarter, APAC investment volume has dropped by about 36%, EMEA has dropped by about 30%, and the most drastic drop is actually in the Americas, which is about 70% drop in volume. The third quarter results are not finalized yet by RCA. These are all RCA numbers, but based on initial estimates, we are seeing an even greater year-on-year drop of 49% for EMEA, 53% for APAC, and a similar 70% for Americas. Next slide, please. Now, this slide actually ranks these metropolitan cities in Asia Pac in terms of investment volume. So that's why we're rolling here. Tokyo has the largest volume of activities in the first half of this year. We saw an increase in activities in Osaka and Yokohama, but we actually saw a substantial drop of 43% investment sales in Tokyo. But overall, Japan actually only see a drop of 17%. So as investment move out from Tokyo into major cities like Osaka or Yokohama. Yeah, so this is a very interesting thing that's happening in Japan for the last 6 months. Now, as you see, Shanghai is the second city that has the highest volume. It seems to be very resilient. We only saw about 4% drop in volume. Now, as you go down, Singapore, as where I am, it's a very small market. So we saw, with this pandemic, it actually affected 70% of the sales volume in investment transactions. But interestingly, this chart also shows the proportion of outbound investment and cross-border investment and domestic investment. So the light blue is the cross-border investment made and the dark blue is the domestic. So interestingly, you can see that both Singapore and Australia is seeing proportionally more cross-border investors, while Hong Kong and Seoul are actually driven by mainly domestic capital. Next slide, please. Now, this is a summary table that put together by our Colliers key market experts, which indicated how the different sectors have been affected today. As in most markets globally, hospitality and prime retail have been most adversely affected, followed by student housing. So for hospitality, it was actually a shock to the sector in this region because it was enjoying a very good run over the last couple of years. Returns yields were compressed and values were achieving new highs before the COVID. So the COVID shock the sector is badly affected with room rates dropped substantially. And in some markets, Hong Kong, we recently saw a transaction at a price of 30% discount for hotel and bought by PRC. And prime retail is actually a sector which also have been affected by e-commerce in recent years. But now, with borders closing on cities, no tourist arrival, lockdown of cities, this sector is definitely being adversely affected. But the good news is that on the extreme end of the spectrum, technology-related real estate such as data centers, technology parks, business parks, logistics, and core assets with good tenants' confidence are pretty much less affected. In fact, there's a surge of demand now for data center across the region, particularly in China, where even the Chinese government is now relaxing regulation to accommodate further developments in this sector. As you can see, residential multifamily is also pretty much unaffected because and this sector also we have not seen much distress as because the government around this region has also introduced measures to support households such as requesting the banks to allow citizens to delay mortgage servicing payment. So this sector is still doing well. Next slide, please. Now, this is my last slide. It sort of summarizes where our economy is doing right now across the region. So it shows the current GDP forecast. The dark blue bar actually shows you the current GDP forecast for this year, and the light blue is the forecast for next year. So we are seeing that most of the APEC key economies are expected to expand by an average of 500 basis points in GDP growth in the next year. So it will be exciting to see the rebound economic growth and opportunities that come with it. So we are seeing China, from a current minus 2.3% to a 7.6% in next year, with Singapore going to hit about negative 5% and growing by 5% next year. So there will be a lot of growth, and we really hope that this will happen. And if Australian economics is right, then we are in for exciting time. Thank you very much. This is the end of my very short presentation.
Thank you, Terence.
Matthias, over to you.
Thank you. Very, very interesting. I mean, a number of the participants will be interested to understand in terms of how the region is doing in terms of COVID. Yeah. So, Jason, you're in Taiwan today, so maybe you can give us your impressions in terms of how the region is doing, how traveling is available, and how the different countries are currently coping. Currently in Europe, we are seeing infections increasing again, and so we are interested to hear how Asia Pacific is doing.
Sure. I would say overall there are different phases with different countries. However, in general, I would say Asia is ahead of the curve compared to other regions. Over the past week, it's Golden Week in China, we saw approximately 600 million people moving around in China. That's about 40% of the population and 80% of pre-COVID tourist capacity. So there is definitely a sign that in China, things are sort of back to normal. I'm here in Taiwan. Taiwan has been one of the better places in terms of handling. The economy is still staying positive for this year. I think overall in the world, IM projected 95% of the countries are going to have negative GDP impacts this year. Only 5% are positive, and I think majority actually of them are actually here in Asia, including Taiwan, China, Vietnam, for example. Japan, I would let Lauren talk about, but Korea, Singapore are different phases. They're opening up. There are definitely some places still see the trend coming up. For example, Indonesia, I believe the past week is still going up. Malaysia has a little bit of spike today or yesterday. So definitely the overall, the countries are watching the situation very carefully. One difference, I'd say the key difference is that in Asia, contact tracing, allowing technology to play a big part of managing where people have been and how many people are contacted has been quite well done. And I think that contributed to a lot of these recent successes.
Okay. Thank you, Jason. Laurent, can you give us a broader picture where you see Asia Pacific situated compared to other regions in terms of markets, evolution, and so on? I think you have covered previously Europe specifically. How do you compare, and obviously you are exchanging with your colleagues, how do you compare your region with Europe, for example?
Yeah, it's very interesting to see the different trends. I agree with Jason. APAC is definitely ahead of the rest of the world. When I speak to my colleagues in Paris or London, the pandemic and the second wave is really present in these countries, and I think there is a different reason why it's like that. But I think, as Jason said, in terms of culture, people in Asia are used not to shake hands or to be very close to each other. So I think it really helps in terms of containing the virus. And I would say that many countries in Asia are used to manage this type of exceptional situation. It could be earthquake in Japan. It could be virus in China. But you feel that people are used to cope with this type of situation. People are used to wear a mask, which is not the case in Europe. I think it's the first time I see my colleagues wearing a mask, especially during conference call. So I think for all these reasons, I think Asia has been very good at containing, especially in the developed countries. But if you look at South Korea, Taiwan, China, even Japan, I think the situation is really good. And I have to say I'm pretty happy to be in Japan today rather than being in Europe for this reason. But I think there is one country where it's maybe a little bit different is Australia. I think Australia has been very cautious, and I think they manage the situation pretty well. But I think the impact on the economy could be a little bit worse. We also the lockdown in Melbourne for a few weeks, and the question is whether it was really necessary to lock all the the city for such a period of time. But of course, all the countries are reacting differently. It's quite unique situation. But I have to say I'm much more confident on the bounce back and the activity coming back to APAC compared to Europe or the US. So very different situation. But I think APAC is doing pretty well so far. Question mark about the second wave, but I'm much more confident for APAC versus Europe today.
Yeah. And traveling is such a big thing in terms of cross-border investment. Yeah. So what we've seen is in Europe, for example, that some of the major larger transactions were postponed during the course of the summertime because international capital couldn't fly to Europe at this point in time. Do you see that the same, or is that picking up in your region? Maybe we start with Terence and then Jason.
Sure. No, cross-border capital flows actually was doing all right in the first half of this year because a lot of the negotiation and a lot of the deal doing were still in Q1. But once the global travel restrictions being implemented in Q2, I think a lot of them implemented late March, early April, and since then a lot of the investment is being held back. So in Q1, we actually saw 29% of the total 28 billion investment volume was from cross-border investment, and in Q2, this actually went up to 48%. So mainly driven by capital from Americas and EMEA, and due to a few portfolio deals in Japan and Australia. For example, Blackstone bought a portfolio of Japanese multifamily apartment from Ampan Insurance in April, 2.7 billion. But this was a deal that they were trying to consummate since early Q1. So and same in Americas. Same for American investors. They have been actively investing in Japan. And some of these large office buildings were acquired by a private equity group in the first half. Australia is a favorite for EMEA investors. So some of the deals we saw, Tang buying the second building. They bought the first building in May this year and just recently bought the second building. I think the reason why Tang is still active in Australia because he has a very strong representation in Australia, in Asia Pacific itself, and they're very familiar with the market, so they can still get back to the market. And of course, there's a JV between ASA and Allianz to buy the Urbanus student accommodation in Australia, right? For $2.2 billion US dollars in April. I'm sure this was a deal that you guys were been talking about since end of last year. So these are all happened in the first half, but based on the latest RC estimate in Q3, we are seeing this cross-border investment is going to drop to 3.6 billion. From the 13.3 billion in Q2. So this is now a record low number. But it's not surprising as we're talking about. So because most of the investors right now domestic players, and because of the travel restriction hinder the decision making by the cross-border players. Thank you.
So both of you are based in the region. So I think obviously that is much easier to do investments when you're based based there and can also do things directly in country. Yeah, Jason, do you see an advantage at this point in time being in the region and having such a established portfolio already? So you are can you take advantage of the current situation?
Yeah, thank you. Absolutely. I think that's why the teams on the ground are hugely helpful. And I think if we look at the transactions that Terence described, and some of the transactions that we're seeing happening now are basically continue to be in the major cities. They're not in the second tiers anymore because most investors, they have, if they invest, other than the portfolios, most of the transactions concentrate to the places that people have been. And these are, again, the gateway cities rather than outside in the city fringes. So having teams in these cities on the ground have transacted before, walked through the building before, either part of the underwriting or they use those buildings as part of the comps, definitely helped in terms of underwriting these deals.
Okay, and in terms of countries, are there any countries or asset classes that you think are more interesting now than they were pre-COVID for you?
Yeah, I'll take that first. I think in terms of countries, it's obviously right now is very bottom up. I mean, I think entry point is going to be the key in terms of making investment. One of the major keys in terms of making decisions. However, I think specifically very similar to what Terence had presented earlier, multifamily in Japan seems to be a very resilient sector. Logistics in Korea seems to be undersupplied. Some of the offices that we actually like in some gateway cities, because right now we are seeing there's a flight to quality. So very well located offices, they're either stabilized or they have some rooms to grow that are well managed. We think it's going to attract a lot more liquidity still down the road.
Okay. And for you, Laurent, do you see opportunities in this kind of market environment in terms of transactions that you have done or that you are looking at?
Yeah, sure. I think as Jason said, we are very positive, still very positive on multifamily in Japan. It's a very resilient asset class, very stable, and if you lose one or two tenants, it's not the same as losing your tenants when you're in an office building. So it's very fragmented, very granular, and that's what we like about residential. It's very defensive, and for long-term investors looking for income, Japan is a great place to invest, and that's probably the only market in APAC which is really developed for multifamily. I think Australia might come back, or might come at one point, but South Korea, China is much more challenging. So I think multifamily in Japan is really an asset class we like. Logistics as well. We believe that the logistics market will definitely benefit from the current situation. We've been investing in logistics for the last 2.5 years in Japan. We are looking at the market in Australia, and we feel that there are interesting things to be done. And of course, the trend of reducing to retail, moving to logistics has been definitely stressed by the situation. The other asset class we like, and we are spending a lot of time on that, is data centers. We have a large platform in Europe called Data4 that we are using as an operating company, but also as a property company, and we would like to invest in data centers in the region. Japan is an interesting sector, is an interesting country for that, but we feel that South Korea and maybe Australia are also countries that could be very interesting for data centers. So if I had to select 3 asset classes today, it would be really data centers, logistics, and multifamily. For offices, exactly the same as Jason, we're looking at really core prime location, core assets for offices, because we feel that today the trend will be for tenants to, if you still want to attract talents, you need to be in the right location, in the CBD, or in locations where talents will join you. We saw some trends like Sony moving from Munich to Berlin. We saw some trends like Facebook going back closer to San Francisco. So all these trends I think are very important to watch, because for attracting talents and for offices, I think CBD or good locations are very important.
Yeah. So if you look at the European region, for example, I think also obviously residential and also logistics are the winners in this crisis. Yeah, and generally what we're also seeing is that a lot of investors or the capital is some of the conservative capital is very risk averse, and it's going after core assets. Yeah? So we even have seen in offices and specifically logistics price increases, since COVID. Is it also the case, Terence, in the region that you are seeing basically that those assets having less risks are much more sought after, and even you have price increases, and obviously those having more risk are more under pressure?
Yeah, definitely. Definitely, the same story goes around the world. There's a logistic, data center, multifamily, and people are more risk averse. People are chasing assets, returns. They are more stable. They are more less volatile with all the uncertainty. So some of the deals, in fact, sales and leaseback is now getting back into fashion. Of course, the credential of the tenants is very important. But if someone want to divest and he has a good financial credential, if he can offer some form of a master lease or sale and leaseback, he will definitely be able to command a higher premium than an empty building. Even an empty logistic building is not going to fetch a same price as a fully let building. So very similar to what you see across the EMEA.
Okay, and there's a lot of debate at the moment in Europe about flexible working / home office and how it will affect the office environment generally. Is that also the case in Asia Pacific, and is there a lot of impact? I mean, in Europe, just to give you a context, yeah, people talk about 2 to 3 days of flexible working, yeah, but obviously, and it's particularly true in Asia. The question is, have people enough space at home to do home office, yeah, at all, and what the impact is? Maybe Jason, you want to elaborate on this? What is the sentiment, and how is the discussion going, and what's reality really?
I have to say, I think it's still evolving. As you're seeing in other regions in Asia, people are discussing that. But I do see that people need to go back to the offices more. As you point out, density is an issue. In Hong Kong, the average per person in terms of living space is only about a quarter of what they see in the States. Apologies, I don't have the figure for Europe, but that shows that people have to go out. Does that mean they have to go back to the office, or they have to work in the coffee shop, or they go to work in a working space? People have to go somewhere. So I would assume culture-wise, you will see here in Asia, people want to build a culture as well in terms of getting people back in the office after COVID. So I think different countries will probably, or even different industries might have different responses. But overall, in Asia, I don't see offices are being too impacted. I think, as a matter of fact, we've heard that some industries are saying maybe they will have sort of flexible working hours, 2 or 3 days per week, working from home, but at the same time, they need more distance when they get back to the office. So the size of the office maybe still need to be flexible. So different factors still moving, but overall in Asia, I would say people need to go to the office rather than staying home.
And then, how do you feel in Japan? Is that the same for you, Laurent?
Yeah, I think it's mixed feelings, because on one side I think people are very happy not to commute for hours, especially in Japan, where the train can be really packed in the morning and in the evening. So I think Japanese people usually enjoy staying at home and not commuting. But as you say, I think the average size of the flats are pretty small in Japan, and we saw during the lockdown that when you had to do a call with some Japanese people, sometimes you can hear a lot of noise with the kids and so on. So it's really a mixed feeling about people in Japan. But I feel that commuting is a major challenge for many people. So what I believe could happen is more satellite office around Tokyo, where people will probably commute for 10-15 minutes from where they live, or maybe 20 minutes, but they will get access to a good Wi-Fi. They will have a proper room, no noise. They will be able to work properly, and that's probably what will happen. So that's why in Japan there are a lot of discussion around co-working companies, and whether co-working companies being around in B location around Tokyo could have definitely some successes. But I believe that working from home full time, or even 2 or 3 days a week, might be challenging for Japanese people. my feeling is that some corporates are reacting too quickly, and we see a lot of corporates saying, okay, we move from now 100% in the office to 50, 60%. So a huge difference, and I don't think they realize all the consequences. For me, it's still very important to be in the office. It's still important to interact with people. Of course, new technology helps, but I don't think it helps in the same way. I think when we're all working on a video conference during lockdown, it was good because we're all in the same position. Now, when you start, having some people in the office, some people at home, it's becoming much more messy. And I think when you're not in the office, you might lose a little bit of the record conversation. So I'm really keen to see how it will evolve, but I don't think it's an easy decision to be made. And I agree with Jason, it's definitely a space to be watched in the next 12 to 18 months.
Maybe let's talk about the more difficult asset classes, i.e. hotels and retail. Yeah, what we are seeing is that in our region, we're seeing that some owners are starting to think about changing the use of hotel space maybe to residential. Yeah? And is that also something that is happening? And I'm have traveled quite a bit in Asia. I'm still having those really big retail malls in mind. Is there something happening there in terms of people changing that kind of use to something different? Terence, you want to comment on this?
Yeah, I think definitely with this COVID situation, owners of real estate are exploring how they can put their real estate into more efficient or effective use. Whether it's retail, whether it's hotel, or even to a certain extent some service apartments or some warehousing. And this is very interesting that this actually instilled the entrepreneurship of some of these owners. They start to think out the box. They start to look at the different options, the demand, and adapt the real estate. Because at the end of the day, the value of the real estate depends on what activities you can bring into the real estate. However, the challenge is in some of the cities are the planning authorities. So the planning authorities in some cities are not able to cope with these changes and this new demand, and they struggle to understand what are the owners trying to do, whether they can, are there fire safety issues, are there other issues that they have to address. So in some of the emerging markets where the planning is a lot more relaxed, I think the landlord and developers or owners have a lot more freedom to adapt all this. Sometimes, so whether or not you can convert a retail center into a logistic last mile delivery center, it all depends on whether you can get approval, whether you can get, because I'm based in Singapore, which is a highly regulated city state. Everything you do, you need to get approval. So I'm probably at the extreme end of this scale where any ideas, you really need to get authorities to look at it and see whether there are other adverse issues if they give you the approval. But to the extreme, I think in cities like Hong Kong, it's a lot more flexible. We are seeing deals done in Hong Kong where the investors buying a hotel distressed property and looking at converting it to apartments, and converting it to office, So it is happening.
Okay. Thank you. Jason, for some of the audience, they might look at Asia for the first time. So what's your view, or maybe also Laurent, what's your view in terms of if you would be a first mover, and obviously you have a lot of experience across the region, yeah? Which city and which asset class would you pick for someone coming to Asia and wanting to do their first investments?
Yeah, thank you. So I think overall Asia is a very diverse region. So for someone new, maybe you want to look at this diversified region as a way to diversify. Japan is very different from Hong Kong, which is very different from China, which is different from Korea and Singapore or Australia. So I would say, look for someone that has the on-the-ground experience that would help you to execute. I would still say that you want to stay in the most liquid cities, the gateway cities, China, Beijing, and Shanghai, Hong Kong, Singapore, Seoul in Korea, Tokyo, Osaka, for example, in Japan, Australia, Sydney, Melbourne, Brisbane, etc. So these are gateway cities where you see the most transparency, most international presence, most liquidity. For someone that's new to this region, I think it might be easier to understand as well.
Okay, Laurent, your view?
Yeah, it's a very interesting question, because when you look at APAC, people feel that, it's a big region, a lot of things to do in APAC. But I would say that between Europe and APAC, it's a lot of difference. First of all, currency. When you invest in Europe, most of the time you can invest in euro or in pounds in the UK. But it's pretty easy to pick up and to invest in Germany, France, or Spain. You will always invest in euro, which is quite easy. When you arrive in Asia, it's very different. You have to invest in different currency, which is usually an headache when you are a global investor, is to make sure that you will properly manage your currency and whether you hedge or not your currency. The tax systems are very different, the structuring are very different. So APAC is a very large region, but when you start looking at what are the investable markets in Asia, as Jason said, it's a few cities, especially when you're global investors and you are core or core plus investor. I would say for core plus investors, stable markets like Japan, Australia, Hong Kong, Singapore. If you're a little bit more, I would say, value add, I think China is probably a very interesting market, but probably more volatile and probably more complicated in terms of structuring, legal framework. So you really need to be a little bit more specialized, and when you invest in China, you need to really understand the risk you're taking. But I would say for a first mover in Asia, I would recommend looking at stable markets like Japan and Australia.
And asset classes, what kind of asset classes would you recommend in this environment?
In the short term, I will focus on, as we say, multifamily, logistics, and data centers in Japan. For Australia, I would probably look at logistics, a little bit of office, but I think compared to what Terence was saying, I'm a little bit more pessimistic on office than you are, but happy to debate. What I find interesting in Australia is what we call alternative assets. As Terence said, we invested in student housing. Of course, short-term student housing is challenging, but I think in the long term, I'm very confident for student housing in Australia. I think a lot of positive ingredients for this asset class. We like healthcare in Australia. We like the build to rent. Multifamily sector is emerging in Australia. So I think alternative assets are very attractive in Australia. So that would be my focus. I would say in the medium term, we'll probably come back to hotels. Of course, hotels, the hotel sector today is very challenging because no tourism, no business travel. But I think in the medium to long term, there's still a lot of potential. Chinese people will probably travel again. A lot of Southeast Asia countries will travel again, and that's that will generate a lot of attractiveness for hotels. So not in the short term, but I think if we come across some distress opportunities in hotels in the next 12 to 18 months, we'll definitely look at them.
And Jason, for you, AXA is quite focused on Japan and also Australia. You are more diversified. In terms of looking ahead, where would you focus your investments in terms of countries and asset classes?
Yeah, I think we touched on quite a few points already. Logistics and multifamily in certain countries. Especially, we're still looking at offices. I think that in the short term, in some cities, gateway cities, they still provide very downside protected risk returns. In the meantime, I think in the next, to say 18 months, see how that war unfolds. If there are going to be any very resilient necessity retail that are trading at a very attractive discount, I think eventually that would be a sector could eventually come back. I know retail may be a very divergent word for some investors, but some people really like it and some people don't like it today at all. But I think if the GDP and people spending and population continue to grow in this region, especially if that will support necessity retail, and some of the positioning might starting to look attractive.
Okay, Terence, do you see beyond what just Jason and Laurent just said in terms of opportunities? Do you see any opportunities in other countries or asset classes that investors should look at in this context?
Yeah, sure. Thanks, Matthias. I think what our two guests have said are all very interesting in the sense that, as they say, Asia Pacific is very diverse. I think each market offers different type of opportunities and suit different capital appetite. So, for example, Japan is always one of my favorite markets because it is a market that offers the largest positive return spread. One of the lowest cost of borrowing, but so so when you do cash on cash calculation, it's very attractive as compared to other markets, and given the stability of some of the lease structure and some of the conservative corporate approach to using accommodation, I think it is one of the most interesting market to invest in. And then with the recent event, so some of the hotels are being discounted in a huge way. We are looking at some deals like 30 to 40% discount for a hotel in Kyoto. One hotel called Nest Hotel was sold at 6.5 cap. Previously, it was commanding a 5% cap. So we are seeing this huge positive yield spread in Japan. Of course, besides Japan, I think Hong Kong, coming back to what Jason said, Hong Kong has been a very volatile market. It's a very responsive market. So if you are, if you are opportunistic and you can take risks, Hong Kong is a very interesting market because with the China government stated publicly that it will support Hong Kong, and we are seeing a lot of PRC investment going to Hong Kong over the last few months. I think it is also an opportune time to look at the market. Vendors, they are very realistic, very pragmatic, the most pragmatic sellers in the whole of Asia. So you give them the right price, they will just let go. They have no sentiment about real estate. But the last one, I'll say, Singapore used to be a very boring market, but it is becoming interesting, particularly for the commercial markets. Recently we see a lot of the fintech company, a tech company from China, going to set up regional HQ in Singapore. The ByteDance, the Alibaba, Google has been there, Facebook has been there, LinkedIn has been there. It has been regional HQ. So more and more, Singapore is becoming like a sort of more as a financial center for Asia Pac, and as also a tech hub for Asia Pac. So Singapore also attract very interesting growth potential. China, the last thing about China is that, as I think Jason mentioned, it has the highest economic growth rate, projected to recover next year. So if you don't invest in it, you're going to miss the growth. But the problem is what to invest in and how do you capture the growth. So, but today we are seeing a lot of prime assets coming out to the market, which usually never made available. In good times, no one is going to sell some of this prime asset. But right now, we are seeing some very primely located, very good assets coming out to the market. So if you are a longer term investor, it is also an interesting market to look at. Thank you, Matthias.
And how easy is it? You elaborate a little bit about interest rates and financing and so on. How easy is it to get financing, and have LTVs changed since the pandemic, Laurent and Jason?
Yeah, happy to start. As Terence say, of course, one of the key attractiveness of Japan is the cost of financing. It's compared to even Europe, in Germany, where usually you can get very attractive financing conditions from German banks. Japanese banks are usually a third of the margin that you could get in Germany. So of course it has a huge positive impact on your cash on cash and your investments. I have to say that over the last 6 months, banks are a little bit more cautious, especially in terms of LTV. Japanese banks were happy to go up to 60-65% sometimes. I think today they are more around 50-55%. In terms of condition, it's not a huge difference, a little bit of spread increase, but that's not a major change. I think same in Australia. We are seeing that banks are a little bit more cautious in terms of loan to value, a little bit more greedy in terms of spread, but it's not a massive change compared to what we went through in 2007, 2008. So I think it might change, but so far I think financing is still available for the right assets.
Jason, for you?
What we're seeing that's very consistent across the region. China remains liquid, Hong Kong remains liquid. Singapore, I think the banks are cautious on loan to value. Also, I think very selective. I think I talked about flight to quality earlier. I think the banks are very selective in terms of attracting to good quality assets with good tenancies. Vacant buildings are probably getting less attention. Australia is where we probably see the most impact. I think domestic banks are less just a flexible in terms of funding development. I think for core assets, good quality assets, the banks are very, very welcoming. But for development type of projects, the spreads becomes much wider. We're looking at potentially doubling the cost. So it depends on the region, depends on the location, but overall, good quality assets, good sponsorship, good relationship with the banks do matter today.
Excellent. Thank you, Jason. So Juliana, you're back, and we opened the forum for questions from the audience. Yeah. So do we have questions yet?
Yeah, sure. No, we do. In fact, let me get back to the pricing topics. You've already touched upon it, but maybe to summarize for the audience one more time, the question that was asked was which markets have more price correction for the core real estate? So if we could maybe just do a quick journey and summarize maybe in priorities.
Terence, if you want to start, which markets have the biggest price corrections, or do you see the biggest price corrections?
Well, it is very subjective, and of course, if you look at hospitality sector, you see the largest correction in that sector across all markets. If we don't see any correction in logistics sector, we don't see any correction in data center. But if you are looking at office as well, we are seeing some correction between 10 to 20% across across some of the developed markets, but even Australia as well as in Hong Kong, we are seeing some of this correction. But we can't really. I mean, if we're talking about deepest correction, I think you have to look at sectors rather than markets. Yeah, there's no market that I see that is more distressed than another market. So maybe Jason and Laurent have your views here.
Yeah, maybe I'll comment on that. So I do see Hong Kong comparatively have a bigger correction. It's not just the COVID, but also they're having some political situations there. Overall, I would say places like Singapore and Korea, there's not much correction at all. In China, the good assets and the non-institutional assets becomes just much wider in terms of cap rates. So there are still a lot of liquidity for good assets, and the pricing and valuations have not changed. But for assets that's outside the city, they're vacant or they're less institutional quality, it requires a much deeper discount to attract any attention from investors. Australia, I think overall has come down by 10, 12%, 20%. We have actually looked at, I mean, somebody mentioned that Melbourne's locked down, but recently there had been a bid. We've seen 20 bids that still went in mostly from local investors and foreign investors alike, I think the valuation came down a little bit, but still a lot of liquidity in there.
Okay.
Yeah, I would agree. I think Hong Kong is probably, one of the market which has been hit not only because of the COVID, but also because of, the global context. So I think Hong Kong is one of them. I think Australia office, it's a mixed feeling depending on, prime location or your location in Sydney or Melbourne. And I agree that the lockdown has definitely an impact on the market. We don't have a lot of comparables. That's one of the issue. I think one asset class which is really suffering in Australia is retail. Not necessarily for the large shopping centers, but I think for some of the smaller domestic shopping center, it's very challenging. Not a lot of transaction going on, but yeah, when you look at valuation, it's a significant drop for certain assets. So the retail in Australia could be one of the asset class which is definitely to be watched.
Okay.
Right. Thank you. In your earlier statement, we already touched upon the discrepancies between your assessment on how is it that office markets in Australia are so stable. If you allow me, I would like to open up that can and get you guys to discuss on it, because that was something the audience was wondering about. So we had the statement earlier, it's quite stable. You've touched upon it now again. Saying that there is actually some issues depending on the location. Would you like to maybe go into that again and elaborate your different opinions on that?
Sure, happy to start. And that's why, when I saw that in terms of least impacted in Australia, in the slide you presented, Terence, office was the least impacted, the less impacted. I saw that. I'm happy to pick up on that. I don't think we have any evidence of the drop of value in terms of transaction. There is drop of value in terms of valuation, but I don't think there are so many transactions to be able to say the market is really dropping by 5, 10, 15%. What we can see in Sydney is that there's a lot of space to be sublet. Same in Melbourne, and usually when it starts like that, it means that there will be some pressure on the rent, and when you see some pressure on the rent, it means potentially pressure on price. So no evidence at this stage, but I think the market is pretty fragile in terms of letting market. So for good location, good assets, not at this stage, but I think for more fringe location, we start seeing a lot of pressure on rents, and that could be the start of potentially drop in value for certain office buildings in the key cities in Australia.
Yeah, I don't disagree with that at all. I think overall we are seeing incentives in Sydney. So for example, rent-free and TIs, for example, ranging from used to be around say 20%, now blow up to about 30%. That will eventually affect how people price their properties. Overall, so far, I think the transactions that happened so far there's mostly to say the ones that are being reported are still in the city center, and similar to what everyone is saying, valuation hasn't really changed that much. We are looking at probably 10% kind of difference maybe. However, I think if the lockdown situation, and the COVID situation continues, I think we're definitely not out of the woods yet. There will be probably potentially more corrections in that market. The counter argument I think Terence made earlier is that there's been a lot of liquidity chasing good quality assets in Australia, especially in Sydney and Melbourne and some of the major cities in Australia. So that trend has not really stopped, feels like. I think there has been transactions that were transacted. I believe Colliers have some figures behind that. The majority of that is actually foreign capital with local asset managers. So regionally, Australia is still attracting capital, I guess, from the region at least.
And I think one point. Sorry, Terence.
Sorry.
Just one point to add, which is really important to better understand the Australian market, is usually your indexation on your lease is between 3 and 5% in Australia, which of course, is very attractive for many investors. When you look at Japan, where there is no indexation at all, and you can sign a 15-year lease with no indexation. It's a good thing in Australia, you still get this high indexation, which is usually floored at 3%, sometimes capped at 5%, but it gives you some potential positive impact, and your NOI is growing pretty fast. Sorry, Terence.
No, absolutely. I was going to add the same point that if you have a nice building with a long WALE, with indexation, all this liquidity will be chasing it. It's quite a polarized market, but there's still a lot of interest. But like what Ron said, those building with short leases and coming out for those is where people have become very careful with. Yeah.
Let me just add another question as a follow-up to this discussion. What we've witnessed in digital talks in Germany with Mr. Leube together is that people are asking questions about the gray sphere of subleasing. Now, do you see a lot of office space across Asia being subleased? How is that trend going? Anyone?
No, well, maybe I'll start that. Again, it depends on which market. I think it is happening in China because of this a bit of a supply of office space. There is a bit of oversupply in certain location. I think we are seeing a bit of it in Hong Kong. I mean, some of them are, like WeWork in Hong Kong has surrendered quite a few large space. So it has been, being taken out or sublet. But in market like Singapore, we are seeing a lot less of this situation because of influx of tech companies. So again, very much. I think Japan, we are also seeing some of this sublet issue, right, Laurent? Yeah. That's all from me.
And that's correct. I think, as I was saying, a lot of corporates have reacted too quickly, and I think their main focus over the last couple of months has been, I need to reduce my space, whatever I can do, and happy to reduce my space with 20-25% discount, and of course it has an impact. But we see that in Japan, we see that in Australia, I understand in China as well. So there is a trend, which is in my view a short-term trend, but I think a lot of corporates made very quick decision, thinking that you can do everything from home. And that's why there is a lot of space to be sublet today. But is it a long-term trend? I'm not sure.
As tempting as it is, yeah. I mean, we've also touched upon, and I think that was a very interesting point in this discussion, that retail seems to have a global problem. So maybe your projections, as we started with the statement that Asia is already one day ahead, and it always will be, do you think that retail will completely remain digital at one point, or is there a chance for something called new retail?
Maybe we should start with Jason this time.
Yeah.
Sure. I say that it is also evolving. I mean, the whole retail industry is trying to accommodate what's happening today. When I talk about necessity retails, I think a lot of that is already online, but there's still going to be some baseline fundamentals that support necessity retail in some part of this region. Overall, however, I think when we get to the prime retailers, I hear that some retailers, instead of having a store downtown, it's more an experience that they want to provide to their investors or customers. It's going to be more of a showroom type of thing. So similar to what Nike is doing with the innovation, what you call the Nike Town next step or the next generation, that is providing sort of brand building type of just a store or storefront in these city centers. But that I think those investments are not going to come in, in the next 6 months, and eventually, when things just say get back to some sort of normalcy, that will come back. So it's very interesting right now. We're all in it to see how the whole industry evolves.
Thank you for that statement.
Okay.
Right. With a look at the time, yeah, we would need a wrap up from you guys. Who's going to take the reins?
So I just will try to do a bit of a wrap up here. I think, as you already said, Juliana, so I steal it from you. You know, Asia Pacific seems one day ahead. Yeah, I think, and obviously has much more experience with these kinds of circumstances or situations. Yeah, I think in terms of economy, it looks as if next year recovery will be there. I think the markets have sort of stabilized. There's opportunities in the market, and even for people now wanting to diversify their portfolio into Asia. The panel clearly stated that you need to stay with the liquid markets, and also ideally need to partner with someone locally. Initially, up until you have a setup like Jason and Laurent, but up until then, I think you need a local partner, and there are certainly opportunities either in the core segment and in the liquid markets like Tokyo and Australia, but also in China where there's a little bit more risk, but maybe also a little bit more return. So I think for me it was extremely interesting to get the insight into the region, and also see how you guys coping, and how things have stabilized and moving ahead, and which is reassuring in terms of that we are coming out of this positively. So at least from my side, thank you very much for taking the time. Thank you to the audience. I hope this was interesting for you and got you a really good insight into the market. Thank you.
Yep.
Thank you.
Well,
Thank you very much.
Yeah, thank you from my end as well for this interesting debate, to the panel, and the valuable questions, of course, that all the participants contributed. If you're wondering what's next, Mr. Leube and I will take our journey around the globe, and our next destination are the United States of America. We will join his colleague, Robert Stamm, Senior Executive Vice President at Colliers International USA, as well as their guest Driss Olcardi, President and Managing Director at Deka Real Estate Services, and Rainer Kommende, Head of Real Estate Investment Management, Bayerische Versorgungskammer, to find out how the real estate markets and their investors are doing on the other side of the pond. The live stream will start at 5 p.m. CET today, and we're very much looking forward to your participation. This digital talk will be for free, as always, and I'm wishing you all a wonderful start into this week and a good end of working day to Asia. Bye.
Thank you.
Thank you. Bye-bye. Thank you all. Bye.